in the top gainers on Nifty 50 because the advanced decline ratio is absolutely in favor of the declines. And if you see in terms of the contribution, HDFC Bank is pulling the Nifty low by almost 180 points, followed by ICICI Bank, Kotak Mahindra Bank, as well as the Axis Bank as well. So clearly, it's the private banking space which has been under pressure. Infosys is holding strong. TCS is also holding strong in today's day of trade. HCL Tech is seeing some good moves. Coal India in the positive. And you have a L&T which is trading in the positive. We've already spoken about Bank Nifty, but let's just pull up the Bank Nifty components as well, because you already have the private banking space which is under pressure. In fact, 12 declines in terms of Bank Nifty. Not a single banking counter which is in the positive on that front. HDFC 6.5%, AU Bank, Kotak, Bandhan, and a Federal. In fact, Federal also reported earnings in yesterday's session during market hours. Now the stock is down a little over 2%. Let's look at broader markets as well and see what's happening on that front. If you can pull up the mid-cap as well as the small-cap index and see. There you go, 0.5% cut, but clearly you have some bit of outperformance coming in from the broader markets vis-a-vis what's happening in terms of benchmark indices. Even the Nifty small cap index is seeing cuts of around 0.4%. Overall, if you see in terms of stock-specific action, Network 18, that stock is up little. It's locked in upper circuit 10%, and this is on the back of news reports indicating about Book My Show. Seeing some investments as well. Apart from that, Cochin Shipyard is seeing gains of 9%. Midani is up around 7%. MSTC, that's an interesting one as well. 7 to 8% is the kind of gains that we're seeing on this counter. On the losing end, you have IEX, which is trading under pressure. Zomato is down in trade. Lodha and Prestige, both these counters from the real estate pack, are also trading under pressure. So that's how the markets are looking like. But let's shift focus in terms of earnings. Now you have MapmyIndia. That stock is in focus as well. The company did report numbers. Now clearly, if you talk about the profitability, margins all have declined, and this is on a sequential basis as well. In fact, overall, if you see from an earnings perspective, the guidance what they've given is 1,000 crores plus by FY27 or 28, which is a 35 to 40% CAGR growth. In fact, my colleague Alex Matthew is in conversation with the management. Let's hear them out. Alex, over to you.
Thanks, Hiral. Well, we're in conversation, as you said, with the management of MapmyIndia, and we're joined by Rohan Verma, the Chief Executive Officer and ED of MapmyIndia. Rohan, thanks so much for taking the time. Let's delve straight into the numbers. 36% on-year growth in the top line, 1% sequential. If you can break that down for us and tell us what contributed to this number.
Sure. Thanks a lot for having me. And the right way to look at MapmyIndia's business is always year-to-date, year-on-year. Quarterly numbers can move here and there because it's a B2B business with various natures of contracts. We've been having a pretty strong open order book, and the revenue growth is broad-based across both automotive and mobility tech, as well as consumer tech and enterprise digital transformations, meaning that a lot more vehicles, four-wheelers and two-wheelers, and even now commercial vehicles are coming built in with our solutions from the factory, as well as in the aftermarket. Fleets are adopting our solutions, or even consumer-facing companies or enterprises across the private and public sector, new age tech companies are adopting more of our map and IoT solutions. So we're quite happy that this quarter we've crossed this 100 crore total income milestone, 92 crore, an all-time high of revenue, growing 36% year-on-year.
Understood. So I was just looking at the CNE, and you were pointing that out, right? Consumer tech and enterprise digital transformation growth of about 71% year-on-year. I'm just trying to understand the mix as it stands right now and whether or not that is shifting. Obviously, it's primarily B2B, but within that, how is it moving?
Sure. These are fairly independent vectors in the sense that the automotive and mobility tech TAM that we have is one side, and consumer tech and enterprise digital transformation is all the large enterprises that can adopt our solutions. And A&M is all the vehicles that can adopt our solutions. So fairly independent. Quarter on quarter, there is variation in the growth, but as a mix overall, this is kind of split approximately half.
Okay, understood. So, as I understand it, heading into FY28, over the course of the next 3 years, we're looking at a CAGR of around 35% for the top line. Is that fair to assume?
That's right. What we've put out is our aspiration and our goal that we're working towards crossing a milestone of 1,000 crores by FY27, FY28, and that translates into a 35 to 40% CAGR if you look at it. But overall, for us, that objective is how do we position the company well? And we are well on our way with a pretty large open order book towards achieving that number in that time frame.
What is the size of the order book as things stand right now?
We declare these numbers annually because annual new order bookings make sense when it comes to B2B business. And so we ended the year at 900 plus crore open order book FY23. And we're quite excited by the order book buildup that we have already. There's a few large wins that we will announce shortly as they develop. So in that sense, we've surpassed kind of new order bookings. Quite excited about that, and Q4 will hold some good news for us.
Okay, look forward to hearing from you. Speaking of opportunities, some of the players in the market that are in similar spaces are talking about opportunities in Ayodhya. Now, I think a lot of attention is going towards that. Do you think that you stand to gain as well? Is there something in the works?
See, MapmyIndia solutions are there in the market. We are winning business. We're a products and platforms company. We're not unlike some other players in services or professional services. And of course, we're not in the early stage as they are in just doing freebies and announcements rather than products and business on ground. When it comes to Ayodhya and UP Tourism, in fact, we've already won business for our metaverse solutions, which is digital twin-like, as well as for tourism-based solutions. And in general, through our consumer app, Mappls app, as well as our traffic management solutions that we work with UP Police, we're already doing a lot of work in UP Police, but we tend to focus on real business that we've achieved, quarter on quarter.
Okay. When I look at the margin front, I see that there is a contraction both sequentially as well as year on year. Sequentially, that is pretty sharp, 585 basis points or thereabouts. But there's even a year-on-year basis, there's a 206 odd basis points contraction. Is that par for the course? As I understand, that's on account of an increase in cost. Where is that coming from?
Sure. We've always said that, look, in FY24, our EBITDA margins will be 40% plus. So if you look at on a 9-month basis, year to date, actually EBITDA margins have expanded to 43% from 42% last year. Quarter on quarter variation will be there. So we have enough buffer for a 40% plus kind of EBITDA margin aspiration. PAT is also a healthy margin of 32-33%. Year to date, year on year. So we're quite happy with the profitability numbers. We've hit 116 crores of EBITDA margin year to date. And as you said rightly, EBITDA is affected by marketing that we wanted to do. That's one thing. And we've been pretty cost effective, but cost efficient yet effective in doing ATL and BTL for the MapmyIndia brand, as well as the Mappls app, which is doing quite well in terms of traction and brand awareness. And hopefully everybody is seeing those results in terms of awareness and adoption. So in that sense, this is planned, this is calibrated. EBITDA margins are strong, PAT margins are strong. And EBITDA growth and PAT growth is also quite strong year on year.
Okay, so steady state above 40% is achievable from your answer. I take that as well. There's an approval from the board to raise 500 crore via QIP. When do you anticipate that will come through in this financial year itself? And what is it going to be used for?
Sure. Shareholder approval has also come in as of end of December. It was voted quite strongly in terms of 99.2% votes towards this resolution. In general, as a company, we've been pretty visionary, I would say, pioneering in building deep tech digital products and platforms. We're obviously going easily toe-to-toe in many cases, surpassing the global tech giants. I think that's something to be proud of as Make in India. But always we've planned beyond just 4-5 years. 4-5 years goals we have laid out last year in our investor presentation. But beyond those 4-5 years, as we look at to international market expansion, as we look at the development of our drone business, where already we are playing a serious role, as well as growth in the consumer business, which opens up a whole new optionality. We want to be well prepared and resourced to be able to deliver on those things as well. So in terms of time frame, I can't tell you the time frame. This is a planned process, not right for me to comment on that. But in terms of kind of the potential for the business beyond the core B2B India centric business that we have for maps and IoT, I think there's lots of growth ahead, and that's what's exciting for us, and that's what we are executing on.
Okay, fair point. You can't give me any indication as to whether it's going to be a fundraise this year or next?
I'm sure at the right time we'll be able to, file the required disclosures to the stock exchange, and,
sure.
and hence at that time be able to talk about these things.
Fair point. All right, Rohan, thank you so much for joining in and for giving us the perspective that you did. And thanks so much for speaking to NDTV Profit.
Thank you very much.
Back to you, Hiral, in the studio.
Thanks, Alex, for getting us this exciting conversation, because with Ayodhya coming in as well, a lot of order flows that are coming in for companies like a MapmyIndia, and one of their closest competitors is Genesis. Let's just pull up the chart of Genesis and see what that stock is doing in trade. It's a smaller name as compared to a MapmyIndia, but there you go. That stock is up almost 3.5% in trade around the buzz of Ayodhya and with regards to the temple on the 22nd. But let's quickly slip into a short break. We'll be right back to talk to the management of Nelco about their third quarter numbers. Company's Managing Director and CEO, PJ Nath, will be joining in. Please stay tuned. Welcome back. You're watching the Small and Mid Cap Show. Let's pull up a Nelco on the screens and see what the company is doing in trade post their numbers as well. The stock is down nearly 1.5% as we speak. Clearly, the margins have seen a dip, and that's mainly on the back of a higher employee expense, as well as the change in inventory that we've seen. Revenues up around 12%. If you talk about the profitability as well, that has gone up around 23%. But let's welcome in the management and understand the breakup so far. Mr. PJ Nath, MD and CEO of Nelco, joins in. Mr. Nath, good morning and welcome to the show. And my first question coming to you is, have the numbers met your internal expectations?
The numbers are good. We are happy with what we are doing. Of course, we want to do more than that, but we are definitely satisfied with what has happened in the last quarter, both in terms of the revenue growth as well as the profit growth that we've seen sequentially as well as over the last year. And it's been very healthy for us. Our overall debt equity ratio has gone down to 0.2. Our debt has gone down to 23 crore, which is the lowest for us so far. So overall, the company has become fairly healthy, and we expect to therefore see much better growth going forward.
Right. So in terms of the debt that you mentioned as well, the lowest in history that you've seen at 23 odd crores, is that going to be a comfortable number, or you think how soon will you become debt free?
We believe that our this 23 crores is not the last. We'll go down below that as well. I would not like to comment at the moment in terms of when we become debt free, but our debts will certainly go down as we go forward in the current quarter.
Right, but my question was, is the plan to become debt free?
Well, there are a lot of new investments we'll be making because of new satellite capacities coming. There'll be new teleports will be opening up, and therefore it is we will also be investing in that. And therefore, the main objective is not to necessarily become debt free, but it is certainly to become more efficient so that we reduce our debt and yet manage our growth that we'll be having going forward.
Right. Overall, if you see in terms of the business as well, where are you seeing the opportunities emerge now for the company?
We are present in all the three segments, which is enterprise, with maritime, as well as aircraft communication. We see growth in all the three segments. Now, there are timing issues. For the aircraft communication, the time could be slightly later because it takes after more time to get the aircraft equipped for getting connected on for satellite communication. Maritime, we've already seen fair amount of growth. Enterprise has been is a big story. There are multiple segments within that. Some of the segments have not grown the way we expected it to grow so far, but going forward, we see them to be growing. So overall, therefore, we see all enterprise, maritime, as well as aircraft communication to be growing over the years. But immediately in this particular quarter, we will see both enterprise and maritime communication growing.
Right. So if you're saying enterprise and maritime communication are going to be the growth drivers in the coming quarters as well, what's the revenue contribution you're expecting from these two segments? Do you expect that mix to change?
Yeah, currently our in-flight and maritime communication is about 27% of the total revenue. It'll be around that, because while the enterprise is growing, maritime is also will be growing. So overall, our in-flight and maritime communication will be in the range of 26 to 27% the total revenue going forward in this particular quarter.
Right. And what's the current order book overall?
We don't specifically talk of any order book because of our business is more in terms of annuity contracts as well as new projects that we have. We focus on getting more annuity contracts so that our base is strong and growing. So suffice to say that we've got enough contracts with us to give us the kind of growth that we've seen this quarter going forward as well.
Okay. And in terms of the Indian space sector, which has been identified as a growth driver as well by the government, what is the role that a company like yours will have, and how are you looking at growing this space as well?
Yeah. We are a satellite communication service provider. We are the ones who offer the end-to-end service to our customers. So far, we are focusing more into the enterprise customers, the maritime communication and in-flight communication. We see all the three sectors to be growing, and we will be playing a very important role as an industry in terms of offering the end customer service, service to the end customers. So that's where we'll be. We will be seeing a lot of change in terms of the kind of satellite being launched, and therefore the type of satellite capacities being available, and the price at which we can will get them, which will obviously come down, because of which satellite communication service will be more affordable for the end customer, and therefore that will grow further. So we will be playing a very important role in terms of ultimately touching the end customer in terms of the satellite communication services. So that's where we'll be.
Okay. And overall, Mr. Nath, if you have to look at even the Indian aviation sector, right? You're talking about in-flight connectivity services. Any talks that you already have ongoing, and how long do you think will it take to actually scale up that part of the business?
We are in talks. First, let me give the perspective that even in the aircraft communication service, Aero IFC as we call it, we've been growing. It's just that our growth so far has been more with respect to international aircraft flying over India. We are in touch. We are in talks with the domestic airlines operators as well for offering the service in the domestic routes. We believe that it will take about a year and a half for it to get started. There are different discussions happening in terms of the business model, the business case, what kind of services could be offered, et cetera, et cetera. So I think that's where it is. So we believe that that will happen in about a year to year and a half's time.
Okay. The recent acquisition or investment that you've made as well with regards to where PIS's Networks is concerned, I hope I'm pronouncing it correctly. What's the status of that, and how is that going to contribute to overall Nelco's business?
Okay, let me give a perspective. We are a satellite communication service provider, which means we offer an end-to-end service, to a connectivity service to our customer using a satellite spectrum. Now, we have also felt a need in the market that apart from satellite communication, the customers would also want to have another media for different reasons, for sometimes for backup, sometimes for redundancy, etc. And to do that, we require what we call as a software-defined modem, or SD-WAN. So we have the option of buying SD-WAN from various vendors which are available globally and offer it as an end-to-end service to our customer, or have a product of our own. But because we are not a OEM ourselves, we are a service provider, and therefore we invested in this company. You pronounce it right, it's called PIS's. That's a very innovative company. It's a startup, but has developed a very good solution, very good product, which caters to the needs of our customer. And therefore, we are able to offer a solution to our customer, which is combination of satellite communication as well as either a 4G or a broadband. So that is what we have done. And we've invested 30% in that company. And this has also given a lot of confidence to our customers that we are serious about this business. And then we see good prospects because of this overall investment that we've done in this SD-WAN company.
Right. Mr. Nath, overall, what's the kind of growth that you're looking at in terms of FY24 and 25 then, with all the levers in play? And what's the key milestone that the company wants to achieve?
In terms of milestones, one of our major focus of the company has been to become profitable, or rather increasing our profits, becoming healthier by balance sheet, reducing our borrowings, etc., which we are achieving. In terms of revenue also, while on a YTD basis, we've grown only 3% from a 9-month perspective. But the important part is that our service revenue within that has grown by 13%. So therefore, our service revenue part has been growing, and that is the trend. So while I'll not give a specific number for what will be at the end of the year, but will certainly be a double-digit growth over last year in terms of revenue. And profits will be at the similar kind of growth that you've seen currently, which is more than 20% either sequential or year on or an annual basis.
Right. So I think that's a good guidance that one should be working with as well. Thank you, Mr. Nath, so much for joining us on the show and speaking to us at NDTV Profit. So that's the management of Nelco. The stock has been slightly under pressure as we speak in today's day of trade, but completely out of time. But that, it's a wrap on this edition of the Small and Mid Cap Show. Lots more lined up on the other side. Please stay tuned to NDTV Profit.